Hi, I'm Steve, Director of Portfolio Management here at KWB Wealth. Recently, we've been getting a lot of questions about bonds and interest rates, so I'm going to give you a few important facts about how those two interact with one another. Most people believe that rates are set by the Federal Reserve. In actuality, the Fed only sets the shortest of short-term rates, the overnight rate that banks can charge each other on deposits. The market, buyers and sellers, are determining the yield of bonds further out on the interest rate curve. Think of yields like a dog on a leash. The Fed has control of the handle, the shortest of short-term rates, and the closer you are to the handle, the more that the Fed rate exerts influence on the rates. But as you get to the end of the leash, the dog has more control. So 30-year rates are really determined fully by the market. That's why currently a 3-month rate is around 4.3, but the 10-year interest rate is about 3.5. The Fed can't control the expectations of the market longer term. Another important fact about interest rates is how the daily fluctuations affect the price of bonds. When interest rates rise, the price of bonds fall. When interest rates fall, the price of bonds go up. Think about it like this. Say you go out and you buy a bond yielding 4%. All of a sudden, interest rates go up to 5%. The market would not want to buy your bond yielding 4% when they can go out and buy a bond yielding 5%. So the price of your bond must fall to meet the demand of the market. This creates an opportunity cost when purchasing bonds. The longer the maturity of the bond, the more opportunity cost that exists. If you have a 1-year bond yielding 4% and rates go to 5%, you would have to sell your bond at a lower price to get the new 5% bond. If rates go down to 3%, you can hold your bond to maturity, but then when you go out to buy a new bond in the market, you're going to get a lower percent on your new bond.